This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. I'm Terry Evans. This is the Wealth Roundup for the week of June 4th with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. We're getting close to the middle of the year, Patrick, close to the beginning of summer, and it's time to check the markets. I was actually looking at the markets today, and I see that they're kind of even with the start of 2025, and year to year, they're up 10 to 15%, depending on what you're looking at, whether it's the Dow, the S&P, or NASDAQ or whatever. And then from just this week, there seems to be a bit of an uptrend.
Yeah. Again, a spectacular recovery from the lows of April, nearly unprecedented near-term volatility. But you're right. When you look back at how you've done over the last 12 months, you have to generally feel pretty good if you've stayed fully invested and have very much invested in line with the markets. There are some exceptions. Oil, which is near and dear to us out here on the prairies, has underperformed. So energy stocks have not maybe shared in that same strong performance over the last 12 months with oil prices being down. But across the board, Canadian equities, U.S. equities, international equities. On our last couple of calls, there's been some weakness in the bond market, but even the bond market stabilized last week. Gold went on a bit of a pause, as did Bitcoin. My sense is it's going to be a little bit tougher of a grind here for the rest of the year. We've been flying a little bit blind with regards to what we call forward-looking earnings. So when we look at publicly traded companies, they generally give us some idea how they feel like they're going to do for the remainder of the year. But as we've kind of talked about before, they can't really provide us the same kind of guidance that they're used to because they're working with a different playbook. But I think investors, when they're going to be looking at their May statements, there's probably going to be a little bit of a sigh of relief.
We have just elected a new federal government, and correct me if I'm wrong, they have not tabled a budget just yet.
Correct. They've talked about how much money they're going to spend, but they haven't necessarily told us how they're exactly going to spend it. So maybe a formal budget closer to the fall, but we're looking at some potentially some pretty serious spending.
Well, that's the thing. A new government, there's optimism or a sense of optimism. At least we hope for that. The other thing too is we hope that the government will run the country like a business and not be a money-losing endeavor. So federal deficits, why do they matter with our new government?
Yeah. So it's timely for us to look at this because a lot of talk in the mainstream media about Trump's budget. So the U.S. new budget that is probably going to get passed sometime this summer. And it is going to come with some tax cuts, but somewhere between $2.5 and $3 trillion worth of deficit spending. Our indications without a budget here in Canada is that Carney is talking about adding about $250 billion to Canada's federal debt. Now, why does this matter? We'd like to think that when government borrows money, it is to help with fiscal prosperity, to give us a better opportunity for jobs and income and for a great place to raise your family. So we're going to be very focused on exactly where this spending is going because, in general, fiscal spending is inflationary. So if the government goes out and spends money on programs, more programs than say just the normal economy would be out buying goods and services, is that with the government stepping in, that's an additional buyer out there competing for materials and for labor. So last week we talked about, are we going to get a rate cut this week? And rate cuts have been a possibility on the back that inflation is under control, whereas taking on more debt is generally inflationary. Now the other thing too is that as the government takes on debt, they're competing for capital. So they go out to the market and they borrow a significant amount of money. let's say something like $50 to $60 billion a year, is that they're now competing with everyone else that's trying to borrow money. Your hope is that they're cutting rates, but if all of a sudden the government is out there also trying to borrow money, is that there's a race for available capital. The other thing that in general is that we say that when anybody takes on more debt, whether or not it's individuals like you or me, or when it's the government, is that generally the credit quality becomes lower. So just in the past week, we saw the U.S. federal debt was downgraded by Moody's. Now, something that we knew that was going to be coming, and that's not necessarily coming on the back that there's been a lot of defaults. Well, there hasn't been any defaults by the U.S. federal government, but it's the size of the debt that they're taking on. So their overall credit quality has deteriorated. So I think, here in Alberta, especially again in the media, there's maybe been some talk that some of this government spending is going to go towards some infrastructure, much needed infrastructure, maybe even in the energy space, maybe even getting more oil to Tidewater so that we can compete for to sell Alberta energy into markets other than the United States. But if it's going to be coming at a cost and with that debt, we have to heavily scrutinize the economic benefit of that additional debt, not only here in Canada, but globally, because again, that new debt is going to be competing alongside with everyone else who wants car loans and mortgages and businesses that are also trying to maybe expand their factories and build up production.
You said you wanted to talk about reviewing beneficiaries. Is that for each person's individual portfolio? Is this something that should be done yearly, biannually? What is reviewing beneficiaries all about?
Yeah, that's a topic I wanted to touch base on. Over the last couple months, people have maybe topped up their RSP, maybe did a last minute RSP contribution, which they were able to do in the first 60 days of the new calendar year. We've actually seen a couple cases this year where not having the proper beneficiary had a negative outcome for families that maybe had lost a loved one. When we think of a beneficiary for something like an RSP, registered savings plan, or a tax-free savings account, or a first home savings account, so any of these registered accounts, is that you're making an election with some type of a rollover. Now, it may be a tax-free rollover, it may be a taxable event, but you're making a choice that is perhaps separate from the directions that you've provided in your will. And so if you have a life event where, say, your spouse or partner has passed away and they were your beneficiary before, and vice versa, you were their beneficiary, going into the bank and kind of updating your estate plan may not be the first thing that you think of. Even let's say you're opening up a new account with a financial institution, maybe you're just really excited about the investment and you're not maybe necessarily thinking of the repercussions in terms of what would happen to those assets if you passed away. And so we think that anytime that you've either moved assets between financial institutions, or you've had a life event, either somebody's passed away, or maybe you've gotten married, or maybe you're into a new relationship, is that you may not want your spouse from your old relationship to be your beneficiary going forward. That might be a tough conversation to have when all of a sudden an RSP statement comes home in the mail and somebody other than your spouse is the beneficiary of your RSP, completely by accident, of course. And then a unique type of beneficiary designation when it comes to tax-free savings accounts is that we really want kind of our listeners to look for this word successor annuitant as a specialized beneficiary for tax-free savings accounts. It's just one of these little nuances that's different with that plan that allows the surviving spouse to receive their deceased spouse TFSA and to be able to transfer it into their own TFSA without having the room. And this is something that you just think would be a given, but we've actually had some cases, albeit very, very rare, where the tax-free savings account was opened up in haste. People didn't look at it for 10 years. All of a sudden, someone passes away. And what's happened is you've had an event where now a person's tax-free savings account has been the only asset that had to be probated when everything else that they had with their estate was not going to be included in probate. So ends up costing you thousands of dollars to perhaps do a probate process when it wouldn't have been necessary.
Very good, sound advice, and especially when out of sight, out of mind kind of thing, right?
100%. Yeah.
Very good. The Wealth Roundup for the week of June 4th with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. We'll talk to you again next week.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.